What's going on, guys? Welcome back to the channel. I've got a great one for you. We're going to underwrite a property off of Zillow. So I do have Zillow and access to the MLS if you guys are going to follow along through the whole video. So we'll be able to pull the rent rolls, look at the expenses, and see what's going on with the property. But the biggest thing here is I'm going to give you access to I'm going to show you the exact model that I use to underwrite small multifamily deals, and you guys can do the same. So that model is in the school community. So if you guys want to join a community of like-minded individuals that are buying their first investment property, either it's residential or some are even doing commercial properties, those individuals are there, and you can bounce ideas off of them in the community, and discuss what's going on in your investment environment. So I also want to throw out there that there's a link in the description and in the bio of my YouTube channel, which you'll be able to book a call directly with me. And during that call, we'll figure out the best path forward to either scale from residential to commercial, or if you're just getting your feet wet and you have your primary residence or you rent and you want to start investing, house hacking into residential properties, that call is just for you. So go ahead, click it, book that call, and I look forward to seeing you guys there. But for now, let's get into this underwriting. And if you guys do find value out of this, please like and subscribe to the channel. It means a lot to me, it helps me out, and therefore it helps you as well. So that's it, I think, for the introductions. All right, so let's get right into it. We're looking in Kenmore, New York. We'll go with this one. So 198 Wabash Ave. This looks like a double. Yep, 2-bedroom, 1-bathroom, built in 1926. Let's see what we can pull from the description. So you're going to be doing a lot of these as well. So you're going to, have to do at least, I'd say almost 50 of these just constantly. It'll help with your analysis, your numbers, your understanding of how to underwrite these properties, environment that you're investing in, and that community. So it just doesn't hurt the more that you do. But all right, roof was replaced 2020. That's great. Rubber balcony. That's great as well. 2017, the upstairs unit received a remodeled bathroom, updated windows and doors. So this is all, very great. So this is all great. This is, I would say, just starting off, this is more, closer to a light rehab. There's not going to be too much value to extract, just not even looking at the pictures yet, just because there's money being put into it. The roof, we have the new remodeled bathroom, some hot water tanks, furnaces. Both furnaces were replaced in 2020, so they're only 6 years old. Both washer and dryers are 2 years old, and the upstairs fridge. So it's nice that it has a 2-car garage. But yeah, so not here to look at, of course, all the pictures, but at least we'll get an idea for the property. Porch looks like that could be redone. Concrete driveway, garage. So this siding, I doubt it's vinyl. It looks like aluminum to me. That's rough. See that the drop-in ceiling in the family room. If you could replace that with drywall, it's not going to add a tremendous amount of value, but you're going to be able to rent the unit quicker. So that's definitely one thing that I would look to do. The floors are in great shape, it looks like. Just going through this quickly. There's a tile shower, which is great. Not bad cabinets, kitchen, granite countertops, it looks like. That's great. Okay, so not too bad. This kitchen up here is a little rough. Definitely a value add. So whatever that unit's getting, you do the kitchen, probably get $200-300 a month more for that. And yeah, everything looks good. Looks like some vinyl windows in there, so those are good. But yeah, all right, let's get into the numbers here. So we'll just pull the MLS number here and for the taxes. And we can see that, yeah, they're both 2-bedroom, 1-bathrooms. They're rented at $1,175 a piece. All right, so now let's get into this underwriting template that I built. So this is, I would say, very straightforward. So if you guys want this, again, it's in the school community, but I've made this straightforward so it's easy to plug the numbers in, and then we can look at all the data that it spits out. So Wabash Ave, it's a 2-unit. It's priced at $299,900. It's $300,000. It is how many square feet? 1909. Built in 1926. So it's 100 years old. Congratulations. All right, so we have a mix of, there's actually no mix, it's just two bedrooms, and they're both rented out for $1,175. So you would want to look at the comps here, when we go for the market rent. That lowers, probably could be updated, like I said, with the, it could be updated. So if you take that drop ceiling out, you just put a drywall ceiling in there. I would say you probably get maybe 150 more a month, maybe 150 to 200 more a month. So not tremendous value you could extract from there. Probably the biggest thing, I mean, it does have washers and dryers in the basement, so it's not like they're hurting. They have to go to a laundromat that's 2 miles away, because in the winter that's terrible up here. So I mean, if you could add a washer and dryer, if there's an easy space to put it in the units, maybe add $50 to $100 a month. But there's probably, my guess here is there's long-term tenants. So let's see how long the tenants have been there. So 2023 and 2024. So for 3 years and 2 years. So they're getting there. So those rents are a little bit lower than the market, just assuming. But you guys, that's an important thing. Like, you want to do this over and over again, because then you're going to look at comps, which is on this tab here, and you're going to fill all of that out with the comps for the rentals and for the sales. So when you're doing the rental comps, and say this is a property you're not going to do any renovations to, then you want to make sure those comps look exactly or is very similar to the condition of the property that it's currently, the condition of the units that it's currently in. If you're looking to renovate this, and you want to find comps that are at the renovated level and that are achieving that higher market rent. You don't want to be at the top of the rent, you want to be at the top of the market, but you want to achieve, of course, a higher rent than they currently are, because you're going to go through, put a lot of money in, a lot of time to renovate those units. So the comps here want to be pro forma comps. Same with the purchase. If you're renovating and looking to refinance, you want the purchase to be the sales comps of properties that have the same amenities that your property has. If you're just looking to see, hey, am I overpaying for this? Well, then it's the exact same thing with the rentals. Is you want to make sure that those comparable sales look almost exactly like and have the same amenities that the current property has. So that's the rental and purchase comps. I'll go through this right now too. And then you have the investment summary. That's once we fill out all the information in the input tab, that's going to put out the investment summary. That's going to put out the investment summary tab. And the nice thing here is you only need to fill out the input tab. Everything else will auto-calculate. So the pro forma, which is great to see what your cash flows are projecting, and then the amortization too. So let's get back to it. So I'm going to say that these will come out at $1,400 for the pro forma after we're done renting and bringing them up to market. So going in vacancy, I like to keep around 5 to 7%. Same with stabilized. Annual rent growth, 1.5%. Utilities, so we're looking at a double. I would say probably looking at $200 per quarter for water, and then sewer in Tonawanda, I believe it's in their taxes, and for sewer, water, trash, so we'll add like another $250 for trash. Again, you want to make sure all of this is vetted. You want to go to the city, the town, call them, maybe the water authority to get an estimated bill for that quarter on what that usage is going to be. I don't know if they're going to give you an exact bill, but it's just things you can do to bolster your underwriting. All right, so maintenance at 7.5%, the repairs and maintenance, and probably a little more on the expensive side, but if you're doing the landscaping and the snow plowing, it might come down a little bit, but that's a very conservative estimate. And you want to make sure that you're filling out the current value and then also the stabilized value too, because the stabilized value is going to take you into your hold period and fill out the pro forma. All right, so next, we're not going to have any replacement reserves nor administrative costs. Insurance, taxes. So let's say insurance, we'll do $1,600 for insurance. Taxes, I have a feeling these are going to be high, so we'll just go back to the MLS. Yeah, that is, so $6,514 for tax, $6,514. I'll bring that across here, $6,514. Kenmore is a expensive area of taxes. All right, so total management fee, we're going to manage it ourselves, so there's no need to. So the only reason why you would include a management fee in the stabilized is because when the lender is going to refinance, they're going to include a management fee in there, but they're going to base the refinance off of the appraisal and not necessarily the cash flow. But they do still do a soft check on the cash flow to make sure that it's not losing money. The debt service is so much that you're not going to be able to pay for it just on the rent that's coming in. So if you want to include it, it is in there. It's probably wise to include the stabilized period, but let's leave it out for now. Interior costs, average $4,000. Let's do $4,500 per unit. Exterior, $5,000 is good. You always want a contingency in there. 20% is probably a little high. This is kind of just a little critique I have on the side here. If you're buying maybe commercial, you would want to do 20%, but maybe that needs to be adjusted down. So 10% is okay here. All right, financing LTV is 80, interest rate 6.8%, 30-year amortization, 4% closing costs. So the loan amount is going to be $239,000. So these are all self-calculating. So all you need to fill out are the highlighted cells with the blue numbers, and that's it. And then everything else will calculate by itself. So hold period, say 8 years, exit cap. We'll keep it at 7.5%. Let's just see. This is just for you guys to get familiar with the model. And again, this model is on the school community. So if you want to check it out, the link's in the description. Go ahead and download it for yourselves. Play around with it. Do what you need to do to get familiar with it. All right, then we have our total closing costs, which is just shy of $100,000. This is going to be pretty, very conservative because we have the renovation budget in there, which you don't need to close. So if you're going to use your income from your job to do the renovations, then of course you don't need that $15,000 all up front. The closing costs, may differ where you are in the states. And then cash reserves, it's sometimes likely, depending on the condition of the property and the lender you use, that you might need it, but you could probably take those out for now. Again, this is just very conservative. And then, we might want to do a refinance. So are we going to do a refinance here? I would say no, just because there's not going to be too much value we'll be able to pull out just looking at the pictures. But if you were, you could say yes, adjust that for the refinance, and of course the cash proceeds right now do not look too good. We're refinancing at the end of year 1, so we put year 2. Okay, the cash proceeds are still negative, which is not ideal because the appraised value through the refinance at the cap rate of 7.5. If we adjust down to 7, it goes up, looks better, right? But let's take a look at this. So if we buy this at a 7 cap, it's only $286,000. So that tells me that the $300,000 price is a little bit on the high side because this is a 7 cap at the end of year 2, which is stabilized in the pro forma because we have the hold period at 8, and then also year 2 is stabilized is everything past year 1, so 2 through 8. So yeah, keep playing around with these numbers. And again, like I said, the refinance is not going to work here, so we'll just keep it off for now. And we still have the $95,000 left in the deal. If you were to refinance, you would want to pull some of that $95,000 out. But yeah, so everything else will self-calculate, which is great. So the income, expenses, the debt service, this is all calculated. So you can just take a look at it, see what the numbers are. The cash on cash return looks a little rough, and the cash flow after the debt service. So would not recommend buying this property if I was in the market to buy a double in Kenmore. Again, we could play around with the numbers on the input side of things. So like I said, $300,000 is pretty steep with that high of a tax bill every year, $6,500, and that's according to the MLS, but something you would want to double check. But let's say $250. Let's see if we buy it for $250, what that looks like. Okay, so it's getting better. We have a negative cash flow on year 1, year 2 is 5%, year 3 is 5%. So, but when we look down at the levered IRR, which is taking account for the time value of money and taking all of these cash flows here down here and putting them to the present and annualizing that. So over the total cash flows for the period, they're going to say, all right, each year it's about a 4 or 5.5% return. And then we have the equity multiples. So yeah, this is just overall not a great deal. Again, this was done very quickly, but just giving you an idea of what this template is capable of. And then we can go over the investment summary. All of this is calculated, pulled from the input tabs from the pro forma. You're going to see how much money you're going to make and what the overall investment is like and if it's worth investing in. Because at the end of the day, we're all investors. So we want to make sure that the investment, that the return justifies the investment, and clearly this doesn't. So the last thing that we can change on the sheet is in this investment summary tab, and it has to do with the DSCR ratios, cash on cash, levered IRR, and the yield on cost versus the cap rate spread. So if you have, say you want to get a levered IRR of 15%, well, this is going to show you right out of the blue that this needs to be reviewed. Or if we need a stabilized DSCR of 1.25, it passes. So we don't, we know that the lender who's looking for 1.25 DSCR ratio is going to give us the thumbs up here. Yeah, so that's it. So if you guys want this template, it's in the school community, which is linked in my description down below. And again, if you guys want to book a call with me, if you're struggling to either break into real estate and you want to get into investing, house hacking, whatever it might be, into residential, multifamily, there's that link in my description and in the bio. And also, if you guys are looking to scale from those, 4 from those 3 to 4 unit properties into a 20 to 30 unit property. There's a link also in my bio. So make sure you click on that and set up a call and we can get a strategy going forward. All right, so guys, if you like this video, make sure you like and subscribe to the channel, and I will catch you in the next one.